Welcome to the world of accounting principles, where businesses navigate the intricate web of financial transactions. These fundamental rules are the compass guiding the journey of recording, measuring, and reporting financial activities worldwide. From balance sheets to income statements, these principles are the bedrock of sound financial management. Let's delve into this crucial foundation together, unlocking the secrets behind the numbers that drive business decisions. Today, we dive into the essence of accounting, uncovering the vital principles that underpin financial clarity and decision-making. From defining the core concepts of business entity and money measurement to unraveling the intricacies of the double-entry system, we'll pave the way for a deeper understanding of how financial information is crafted. As we navigate through timing principles like accrual and revenue recognition, and explore measurement standards such as historical cost, we'll equip ourselves with the tools needed to decode the language of business. Join us on this journey as we decode the financial landscape and unlock the secrets it holds. Have you ever considered the invisible wall that separates a business from its owner? The business entity concept emphasizes this distinction, ensuring that business and personal transactions remain separate. By viewing transactions from the business's perspective, not the owner's, accurate financial reporting is maintained. Picture Sarah's bakery. Her $50,000 investment is distinct from her personal funds. This clarity benefits stakeholders, aiding in a true understanding of the business's financial status. Remember, what's business-related stays in the business books. In the world of accounting, the money measurement concept reigns supreme. Here, only transactions that can be quantified in dollars and cents find their way into the ledgers. Purchases, salaries, and sales are in, hours, units, and emotions are out. Tangible actions like buying equipment, paying wages, and selling goods make the cut. But when it comes to the intangibles, like employee morale, managerial experience, and customer satisfaction, we hit a snag. While these qualities hold value, they remain off the financial radar due to the challenge of measuring them in monetary terms. In the realm of accounting, numbers speak louder than sentiments. Imagine a world where every business had to be valued as if it were closing tomorrow. That's the opposite of the going concern concept. This concept assures us that a company will keep going strong, allowing us to record assets at their original cost. For instance, a factory's worth is its purchase price, not a fire sale value. This assumption keeps financial statements relevant for ongoing operations. However, if there are signs of trouble, like bankruptcy risks, different valuation methods are needed. Remember, the going concern concept secures the future, shaping how we see a business's present. Ever wondered how a business keeps its financial house in order amidst a flurry of transactions? Enter the accounting equation, the bedrock of double-entry bookkeeping. Picture a seesaw where assets, the resources owned by the business, are balanced by liabilities, claims by creditors, and owner's equity, the owner's stake in assets. From cash to loans, every item has its place in this financial equilibrium. Just like a seesaw must stay level, this equation ensures that everything a business owns is funded either through borrowing or the owner's investment. It's a delicate dance of balancing act. As we delve into the practical application of the accounting equation, we witness its dynamic balance in action. Each transaction triggers a ripple effect, impacting multiple elements while ensuring equilibrium. The owner's $10,000 cash injection boosts assets and equity. Purchasing equipment for $3,000 shifts assets but leaves liabilities and equity untouched. A $5,000 bank loan increases both assets and liabilities. Providing $2,000 worth of services elevates assets and equity. In the end, with $14,000 in assets, $5,000 in liabilities, and $9,000 in equity, the equation remains intact: assets equal liabilities plus equity. A testament to the equation's unwavering harmony amidst financial flux. Takeaway: the accounting equation's resilience lies in its balance, reflecting every financial move with precision and consistency. In the world of accounting, the double-entry system is a fundamental concept that ensures accuracy and balance in financial records. Every transaction involves at least two accounts, with each debit having an equal and opposite credit. This meticulous system guarantees that the accounting equation always remains in equilibrium, serving as a safety net for detecting errors. For instance, when a business buys supplies for $500 in cash, the supplies account increases by $500, debit, while the cash account decreases by $500, credit. Despite these changes, the total assets stay constant, preserving the balance. Remember, in this system, debits must always equal credits. Any deviation signals a mistake in your recording. Stay vigilant, and let the numbers guide you to precision and accuracy in your financial reporting. Ever wondered why timing matters in accounting? Enter the accrual concept. It's not about the cash in hand but about when transactions actually happen. By recording revenues when earned and expenses when incurred, we paint a precise picture of business performance. This method aligns income with the costs that drive it, truly reflecting the period's economic activity. No more waiting for the money to show. It's all about timing the tale of business success accurately. And remember, in accounting, it's not just about the cash flow, but the flow of economic reality. Ever wondered how businesses track their revenue? Let's uncover the difference between accrual and cash accounting. In the accrual example, a consulting firm completes a project in December but gets paid in January. With accrual basis, revenue reflects the work done, painting an accurate picture of the month's activity. However, cash basis delays recognition until payment, masking December's true performance. Most businesses opt for accrual accounting for informed decision-making. Remember, how you track revenue matters for a clear business vision. In the world of accounting, the matching principle is like pairing up expenses with the revenues they helped bring in. It's all about creating a clear cause and effect relationship between costs and income. Without this matching, our view of profitability would be all mixed up. Just picture recording all expenses right away, but spreading out the revenue over time, it would paint a misleading financial picture. For instance, when you buy inventory in January for $1,000, sell half in February for $800, and the rest in March for $900, it's crucial to match the expenses accordingly. This means recording a $500 expense in February to match the $800 revenue and another $500 expense in March to match the $900 revenue. This way, we avoid recording the entire $1,000 expense in January when the inventory was purchased. Remember, matching expenses with revenues is key for accurate financial reporting. Why record assets at their original purchase price, known as the historical cost concept? It's a practice that values reliability and objectivity over market fluctuations. By sticking to the actual purchase price, accounting stays grounded in facts backed by receipts and contracts, unlike market values that are ever-changing estimates. This approach offers clear advantages. It's objective, verifiable, and hinders manipulation, making auditing a breeze. However, this method has limitations too. It may not reflect current values, overlooks inflation effects, and can undervalue assets that have appreciated significantly. Consider a scenario where a company bought land for $100,000, now valued at $250,000 in 2024, yet still reflected at the original purchase price in the records. This illustrates the steadfastness of historical cost accounting. Remember, while it may not capture current worth, its stability and reliability are its strengths. Revenue recognition is a key principle in accounting, focusing on when revenue should be recorded. Revenue is recognized when it is earned and realizable, not necessarily when cash is received. This principle guides us through 4 steps: agreement, delivery, measurement, and recognition. For example, an online retailer records revenue when products are shipped, not when payment is received. Remember, revenue recognition aligns with when value is provided, not just when money changes hands. It's about capturing the essence of the transaction accurately. Now, let's delve deeper into how this principle shapes financial reporting. In the dynamic landscape of revenue recognition, different business models demand tailored approaches. Consider these 3 scenarios. In a retail setting, revenue is recognized at the point of sale when the customer exchanges payment for the product. This immediate transaction aligns with the principle as both delivery and payment occur simultaneously. Transitioning to a software company, revenue is recorded upon software delivery or the commencement of a subscription period. Here, the service period initiates, even if payment is received annually upfront. Contrastingly, in a construction project, revenue is acknowledged gradually as the project progresses, reflecting the percentage of completion. Long-term endeavors necessitate revenue recognition as work is earned over time. Each scenario intricately weaves the revenue recognition principle into its operations, underscoring the need for meticulous application. In the world of accounting, the accounting period concept is like a timekeeper, dividing a business's life into manageable segments for reporting. Monthly snapshots cater to internal management decisions, while quarterly reports unveil seasonal patterns, especially crucial for public companies. Annually, the big picture emerges with complete financial statements, tax obligations, and detailed analyses. These time divisions help stakeholders detect trends, make projections, and benchmark performance. Crucially, as each period closes, accountants fine-tune figures through adjusting entries to align revenues and expenses accurately. It's about creating clear, comparable periods to empower informed decision-making. Ever wondered how the 10 accounting principles collaborate to shape financial decisions? They form a cohesive framework, not standalone rules. Picture this: in a business scenario, these principles dance together, guiding every move. It's like a well-choreographed performance, each step deliberate and interconnected. This synergy isn't just about following guidelines, it's the art of creating reliable, comparable financial insights. Accounting isn't a rigid set of instructions, it's a dynamic system that paints a clear financial picture. Ever wondered how accounting principles come into play in a real transaction? Let's dive into TechStart Incorporated's sale of computers to a school district. TechStart records a $25,000 revenue and $15,000 expense, applying principles like business entity, money measurement, and double entry. By following the accrual concept and matching principle, they accurately show a $10,000 profit in September. This transaction showcases the practical application of accounting theory, painting a clear economic picture. Remember, proper recording ensures an accurate representation of a business's financial health. Have you ever wondered what lies at the core of accounting practice? The foundational principles we've covered today are the backbone of financial information reliability. Historical cost and going concern offer verifiable data, while accrual and matching ensure accuracy. Through consistent periods and measurement, comparability is achieved, allowing for meaningful comparisons over time. The equation and double entry system guarantee balance and mathematical precision. Mastering these principles not only sets the stage for understanding complex accounting topics but unveils the logic behind financial reporting. Remember, these are not just rules, they are the essence of financial clarity and decision-making. Welcome to Quiz Time. Let's test your understanding of fundamental accounting principles. Question 1. For the business entity principle, John using $5,000 from his restaurant's cash register for personal use should be recorded as C. As an owner withdrawal. Question 2. Regarding the accounting equation with $100,000 in assets and $60,000 in liabilities, the owner's equity would be A. $160,000. Question 3. Concerning revenue recognition, when a law firm completes work in December but gets paid in January, revenue should be recorded B. In December, when earned. Remember, accurate recording is key to financial clarity and transparency. Welcome back. Let's dive into the final set of quiz questions to test your accounting knowledge. 1. Matching principle. If a company pays $12,000 for a one-year insurance policy in January, how much should be recorded as an expense in January? The correct answer is C. $6,000. 2. Historical cost. When land purchased for $200,000 is now worth $350,000, how should it appear on the balance sheet? The answer is B. $200,000. 3. Double entry. When a business buys equipment for $10,000 cash, how many accounts are affected? The correct response is B. 2 accounts. 4. Accrual concept. Which accounting basis offers a truer view of a company's financial performance? The answer is B, accrual basis. Review any missed questions to solidify your understanding of these crucial accounting principles. Keep up the great work on your accounting journey. Remember, mastering these principles is key to your success in the world of finance.